What's going on, ladies and gentlemen? Mark Cassara here, and welcome to the show. Today's episode, I'm going to show you guys the power of a properly structured and well-designed life insurance policy and how you could potentially use it to accumulate wealth and pass it to the next generation absolutely tax-free. In this episode, we're going to talk to you a little bit about what we call the 3 ways that money grows. So without further ado, guys, I'm going to jump right into this. If you do find value in this video, please make sure you go ahead and like and subscribe. And if you don't find value and you don't enjoy the video, leave a comment. Let me know either way. Give it a thumbs down. Whatever you do, it definitely helps the algorithm move this video further. And so let's jump into it real quick. This is called the 3 ways that money grows, guys. And it's a little way that basically tells people where our money grows and how to grow it properly. Let's go ahead and look at the first way. Number 1, the first way that money grows is what we call the fixed category. This is your bank accounts, your money market accounts. These types of accounts are slow to no growth, anywhere from 0.04 to 0.06% interest on an annual basis. Now, the interesting part about these slow growth to no growth accounts is the banks, right? These banks, these big bankers use the money that we put inside of our accounts and they go ahead and lend it out 9 different ways. 9 different ways. And they're making double-digit returns, anywhere from 10% to 24% on our money, and they're giving us the scraps. Now, have you guys ever heard of something called the Rule of 72? Okay, the Rule of 72. The Rule of 72 states that if you divide 72 by your interest rate, that's how long it's going to take for your money to double. So if we take 72, we divide it by, man, it says use an easy number. We divide it by 1%, not even 0.04 or 06. If we divide it by 1%, it's still going to take us 72 years for our money to double. Now, guys, I don't know about you, but I'm not planning on living another 72 years. Maybe, who knows, if Elon Musk will create some crazy thing that keeps us, alive till we're 200 years old. But for the most part, I'm not anticipating living until 72 years or another 72 years. So here's the thing about fixed accounts. We like it because it's safe, it's secure, it's there when we need it, it's liquid, which means we can access that money. We go to the bank account, we can go ahead and take out, $20 from the ATM or the teller when we need that money. But the problem is it just doesn't grow, it stays still. Guess we have to ask ourselves, where's the next best place to grow our money? Well, there's another account or another strategy, what we call the variable. So this is the variable category. These are your 401ks, your IRAs, your Roths, stocks, bonds, real estate, cryptocurrency, Forex. Those are all variable accounts. What that simply means is when the market's good, it goes up, but when the market's bad, your money goes down. When the market's good, it goes up. When the market's bad, it goes down. So it's a little bipolar, going up and down, not stopping. And the problem is a lot of people end up losing their money, especially when it comes to retirement. Nobody likes losing their money, guys. Okay? These types of accounts, we like them because of the potential growth that it has. We don't like them because of the risk that's involved. And nobody likes risk. Nobody likes to lose their money. Now, some young guys will say, man, I like a little bit of risk in my life. I like living dangerously. I like living on the edge, right? Well, kudos to you. By all the more power to you. Go ahead and risk your money. But when you're middle age, 30s, 40s, 50s, 60s, you're getting ready to retire, you don't have the capacity or the desire to risk your money as much as you did when you were younger. So although we like these accounts because of the speculative growth, we don't like them because of the risk. So it's not necessarily the best place to keep all your eggs. You know the old saying is, don't keep your eggs all in the same basket, okay? We don't want to keep all of our eggs in a variable account. So if we can't grow our money fast enough in a fixed account, okay, remember the fixed here, and it's too risky to grow our money in a variable account, where's the next best place to put our money, to protect our money, and to potentially grow our money? Well, there's another category called the index category. Now, this category or this strategy has been around for years, been around for decades. But middle-class America doesn't necessarily know it as well as they should. As a matter of fact, a lot of the elites and a lot of the rich people in our country have been using these strategies for many, many, many years, and they've been keeping it hush-hush. They've been keeping it on the D-low because they don't want middle-class America knowing how to accumulate and generate and create wealth, because that means you would be the same as them. And society overall, they want to keep us poor. They want to keep themselves rich. This strategy has been around for quite a while. Now, it's a little different than indexed funds in the market. We're not talking about a variable product. We're talking about an indexed strategy. Now, this strategy has been used for decades, since the late 70s and the early 80s. A guy named E.F. Hutton created a company. His company designed a product that said, I want the upside potential of the market with the safety and security of the banks. And he created what we call indexed universal life insurance. There's another product called indexed annuities. Now, these types of life insurance products, they have the best of both worlds. They have the safety and security of the banks. They have the upside potential of the market without any of the risk. So when you put money in there and the market goes up, you profit. But when the market goes down, there's something called a 0% floor, which means you never lose. When the market goes up, you profit, but because of that 0% floor, you never lose. When the market goes up, you profit, but again, because that 0% floor, you never lose. So it looks like a staircase in a way, right? Where you profit when the market's doing well, but if the market's not doing well, you're not ever going to lose any money you put inside that product. Now, we got to talk about a few things, guys. The index strategy is one of the only places in the world that has a 0% floor. That's inside of a properly structured and well-designed life insurance policy. Now, the way that we are supposed to design these policies is with what we call low death benefits, maximum cash value. Now, some carriers, or some agents rather, will take the death benefits and they'll boost them up, and they'll give the client a lot of death benefits. And what that does is that increases their target premium, which is the premium that they get paid commission on. Okay. Now, some agents, beware of this, buyer beware. Some agents will increase the death benefit, lower the cash accumulation so that they'll pad their pockets. Now, not every agent is created equal, guys. I want you to know that right now. But in our firm, we put the client's needs before our own. So in other words, we take the client's money. We make sure that the client's earning compound interest and growth. Whenever the market does well, the client's going to profit, but that 0% floor is going to prevent them from ever losing. We make sure that we take the death benefits down to a legal minimum based on several IRS tax codes so that there's less fees inside the policy. There's less cost of insurance inside the policy, okay? When there's less fees inside the policy, more of your policy premium goes into what we call the cash value pool. Now, these indexed accounts, they're actually really cool. You can put money in after tax. It's like putting inside of a Roth IRA, right? But it's a Roth IRA more so on steroids. There's a lot more benefits to it. You can put money in after taxes, and when it goes in, you can start to use that money tax-free, okay? You can use it via the loan option. The loan option allows you to use your money tax-free because when you take a loan out, you're leveraging debt, and the IRS can't tax debt. It allows you to grow your money tax-free. Okay, when you're growing your money tax-free, essentially they call it tax deferred, but you're never ever going to pay taxes because you're never ever going to withdraw that money unless you need to. The way that you use that money is through the loan feature. As long as you're using that money through the loan feature, no matter if it's $100, $100,000, or $1 million, you're going to use that money through the loan feature. You're never, ever, ever going to get taxed on that money. So you can use it tax-free, you can grow it tax-free, and you can pass it over to your beneficiary 100% tax-free as well. How, Mark? Well, life insurance is a non-taxable asset. You can transfer money to your beneficiary and the IRS can't come after you. Uncle Sam can't touch it. Credit card collection agencies can't touch it. Judgments can't touch it. It doesn't get stuck inside of probate court. It's a bona fide contract between you, the carrier, and the person that you put on that policy as your beneficiary. And you can even have a fourth person on that policy called a contingent beneficiary. That's if you and the beneficiary pass away, who's that money going to go to next? So we need to, again, look at this. We can't avoid putting our money in banks, right? We need banks. You work, you get paid, that money goes into a bank account. You can't get paid and stick it into a life insurance policy, okay? Some people ask that question a lot. You can't do that. We need bank accounts. That's how we pay our bills. That's how we pay our expenses. But anything above what your expenses are or above what your bills are is just extra. And if you keep that in your savings and you're only earning 0.04 to 0.06% and inflation is 3%, well, you're actually losing purchasing power as long as your money is inside that bank account. So we keep just enough money in there to pay our bills, pay our expenses, maintain our lifestyle. The extra and above, we have several places we can put it. We can put it in a variable product. We can also put it in an index product. Now, the question between this, what's the difference, Mark? Well, we talked about it. If you put your money in a variable product, there's always going to be risk associated to it. You put it in a 401k, you max your 401k out, and the market crashes like it did in 08, crashes like it did in 2000, you're going to lose your money. There's no way around it. Now, you can allocate all your money to go inside of bonds, but there's zero growth aspect. Very, very minimal growth takes place if you put all of your money in bonds. Now, we recommend be diversified. Keep a little bit of money in bonds, put some in the more risky assets. That's fine. But if you put all your money and you're relying on that 401k to give you the life that you truly desire when you're ready to retire, you're not going to get it, sir. I'm sorry. Ma'am, I'm sorry. You're not going to get it. Because we see now in middle-class America right now, the average 401k has about $167,000 inside of it. And those that have more than that have worked for a company for many, many, many years. They may have 300, 400, 500,000 in there. I'm sorry, that's not enough to live on when you retire. And that's based on what we call the 4% rule. The 4% rule says you can only touch 4% of your retirement money when it comes to retirement. And as a matter of fact, they recently changed that rule to 2%. They said you can effectively only take 2% out of your retirement and not risk running out of money when you truly need that money, when you want to retire. So if you have $1 million inside of your retirement account and you try to retire on 2%, guys, that's $20,000 a year. And that's not even taxes. That doesn't even account for taxes being taken out. Imagine you have $20,000 and you get another 20% in taxes taken out. Well, what does that leave you with? That leaves you with $16,000, $17,000 to live on. I'm sorry, ma'am. I'm sorry, sir. You're not going to be able to live on that amount of money when it comes to retirement unless you're living in a shack or living with your kids. And maybe that will pay for one bill. Okay, so we look at the three ways that money grows. We got the fixed, which doesn't grow much. We got the variable, which is way too risky for most middle-class America. Then we have the indexed. The indexed is the only place you get that 0% floor. You get to put your money in, grow it tax-free, leverage it tax-free, and it gets passed over to your beneficiary absolutely tax-free. So if in a perfect case scenario, you had money to put somewhere and you had these three options to choose from, fixed, variable, or indexed, where would you place your money and feel the most confident that you're going to be able to grow it and you're not going to be able to potentially lose it in a down market? Of course, you're going to say indexed. As a fiduciary, a life insurance broker that has been doing this for several years, our money doesn't come out of the life insurance policy. Our money comes direct from the carrier. The carrier pays us to do the educating and the connecting of the client to the billion-dollar companies that we work with. Okay, so if you're looking for an opportunity to protect your money, protect your assets, protect your family, and grow it at the same time with zero risk of loss, ladies and gentlemen, I want you to go ahead and let me know in the comments if you'd like a free strategy call. I'd be happy to sit with you. I'd be happy to educate you a little further on this, this material that I showed you in this video. I love educating people. We sit down dozens of people on a weekly basis, face-to-face over Zoom, and we sit down and we educate them. And if you end up working with me, awesome. I'll make sure that I take care of you. But if you don't end up working with me, that's fine too, because I know that I educated somebody and they're going to be able to go and make an educated decision in the future, even if they work with a different agent or a different broker. With that being said, guys, thank you for joining us in this episode. Make sure you click that subscribe button. Make sure you leave a couple of comments. Let me know some questions that you have. I'll make sure I answer them in the next video. And until the next one, hope you live well, laugh loud, and learn to be a better you. God bless, and we'll see you in the next one.
Now is my time to shine. When your time comes, don't postpone it. When others doubt and out, you don't condone it. Truth be told, yourself is your toughest opponent. When your moment comes, grab hold and own it. Never let go, stand tall and hold tight. Overcome